Okay, gang, the market, you keep hearing how it's making new highs every day, okay? Well, it's being engineered to make new highs every day. Let me explain, and let me tell you what this market's going to do. First of all, as you know, these two pullbacks here represent the dot-com crash, represent the housing crash, and we should have had a QE crash right here. Should have pulled back right here and had the QE crash here. So they all should have been about the same. But we had an extension. They extended it. Now, where did this extension come in? Well, you'd love to hope that we came in from earnings growth, okay? But we don't have earnings growth. That's the thing. We didn't have earnings growth here either. This here was all QE, okay? That's what that was. They injected $3 trillion, okay? They injected $3 trillion, and you can see it on the injection right here, what they did. Here's the injections of money, December 2008. And what they did is put $3.3 trillion in from December 2008 to 2012, okay? And $3 trillion to push the bank stocks up, to push the market up. Companies weren't making earnings. Remember how stocks go up? Stocks go up when companies make earnings, okay? Profits. Think of it as profits, make earnings, make profits, and it pushes the stock up, all right? Well, that's not what's going on. Now, when it stopped right here, 2012, they decided, well, what are we going to do now? Because every time they artificially stimulated it with this QE nonsense, first of all, they would lie to us and they would tell us, oh, this was great for the economy because by taking money and giving 0% interest money to the manufacturing people and so forth, that the companies are going to get excited. They're going to go out and buy equipment and they're going to spend money on IT, create a lot of jobs. The economy's going to grow, which was all a lie. That's not what companies did. Okay, companies took the money and they bought their own shares back. That's what they did, okay? Then it stopped. Then they did another QE, and they went up, and then it stopped and pulled back. Then they had to do another one. Went up, and it pulled back, and they did another one, okay? Then you can see, they don't last, okay? QE is not meant to last. QE does not create jobs like they tell you. It does not get companies excited to go out and buy equipment. And all it does is take company CEOs and they go borrow money from the Fed near zero, put that pile of money where they already made with their profits, pile it into the company for one reason, buy stocks, not equipment. And therefore, it doesn't help anybody except the CEOs who are making 320 times the laborer. So get that out of your mind. Here was all stock buybacks, 5.5 trillion. Okay, companies bought their own stock to mask how bad their earnings growth, how bad their profits was. So everything is artificial, all being held up. Now we ran into a problem where the market started to consolidate right here. Started to go sideways, started to have a problem here because there was no more QE. Doing some stock buyback, doing some bond buying, but they're not like here. Here we did 85 billion a month, or back here, 85 billion a month in bond buying. What does that do? 85 billion in bond buying means that we go in, the Fed goes in and buys all the bonds to make the yield drop so it's unattractive, so the nations who buy our debt, like China, Saudis, they don't buy our debt. Because why would they? They don't want 1.3% interest, 1.4%. They want 3%, 3.5%. So it forces them into the stock market, and that's what pushes the market up. So where do we stand today? Well, today the market's been going sideways, and they needed one more. They needed one more move, but unfortunately, what happens? We had this Brexit, okay, and everybody felt the market was just going to collapse like this, okay, come all the way down like this here. Well, they didn't, okay? It didn't happen. Why? Because they artificially came in and they held the market up. The Federal Reserve stopped it right there, okay? Stopped it dead in its tracks. So now what they're doing is trying to move the market up. So what they did is this. It was real simple. When the market dropped like this, because of the Great Britain leaving EU, they turned around, they stopped it right there so it wouldn't go further, and then they turned around and they forced it back up. Okay, the Federal Reserve bought stocks, popped it back up like this. Then it was pulling back again here like this, see? Then just like this, see all these lower highs. Then they decided, let's rig the job count from May that was at 38,000, which dropped to 11,000. Let's say in June it was, I'm sorry, yeah, let's say in June it was 286,000 jobs. Well, that, of course, made everybody cover their short positions. Now it's up here. But here's the problem. They got a problem. This is all short covering. This here stock buybacks, not like you had back in here. Okay, we don't have that kind of money. But that's what's artificially holding it up. And they're doing that so that they can make sure that Hillary Clinton, okay, doesn't get caught. They wanted the breakout. See how that little pop out? They want to make sure that Hillary Clinton gets elected. And they know that she can beat Trump. The only thing would beat her if the market started to collapse. Everybody would go to Trump. If they keep the market up like this, Trump's going to lose. Okay, so that's their game. So what we're hoping they do, and we can see it because earnings are getting worse and worse. Debt is getting higher. Our growth is slowing. Like I said, think about this way here. Our GDP, or our economy, the size of our economy, if you take and add up everything we produce about $17 trillion a year. Okay? Of that 17 trillion, we're only growing at 2%. Are you nuts? That's crazy. We're growing at 2% of the 17. That is insane. Okay, that's insane. But here's the problem. Our debt of the 17 trillion has gone from 8% of the 17 trillion to today is 23%. That's the killer. That's why we can't get growth in the economy. Because when you have that kind of debt, you can't grow because you don't have people saving. You don't have, and without savings, you can't grow small businesses who create jobs. And it's a vicious cycle. So what are they going to do? Well, with that kind of debt, we can't grow this market earnings. You can't get earnings to push this out. You can't get profits, okay? Not with that kind of debt. Remember, 23% of 17 trillion. Are you kidding? So they're going to do what they did right here, these QEs, and see how they moved up. 80%, 33%. So they think they can move this market up between now and November about 40% and get Hillary Locker in for the presidential election. So that's where we are. We're taking advantage of it. And I'll tell you how we take advantage of it. We take advantage of it with our charts, okay? And especially our color-coded charts, okay? And if you have a color-coded chart, if you're a gang member with a color-coded chart, MV2, especially if you're busy, okay? If you're busy, then all we do is take stocks. Like right now, we're looking at some good stocks we think are on sale, like Valero. That's on sale. We think it's a great stock, okay? It's on sale. It's really gotten beaten down, but see how it's turned green? So she's just ready to start buying now, see? So we're watching Valero, okay? Another one we think that got beaten down is ready to buy is TSO. That's another refiner. TSO, that's looking good too. And you can see it here starting to go up. So when it greens, we start buying it, okay? We start buying it. When it's red, we sell short, make money on the way down. Right now, we look like they're going to try to keep pushing this market up every day, and therefore we can make some money. But here's the key. You can feel comfortable because when they stop, when it stops going up, okay, it will turn red, so you know when to get out. Yeah, isn't that nice to know? So you know when to get out. Yeah, okay, your broker's not going to tell you. So the market's going to be stuck where we are right now. We may pull back maybe 5%, but everybody's waiting for QE4, which they got to do. They have no choice to push this market up 40% more. I don't see any more than about a 5% pullback in this market. They may get that before the QE. All right? I will see you on the charts. Join my gang if you're not a gang member.